In January 2026, the price of silver surged past $120 an ounce, only to suffer a massive crash shortly after. While the price oscillates wildly, the physical market is tightening. Global supply and demand haven't been this imbalanced in decades. This line chart maps out a classic falling wedge. In technical analysis, this shape begins wide at the top and compresses as prices move lower, signaling that selling pressure is exhausting itself. Notice how the pattern completes right at the base of that brutal 35% correction following the January peak. The price has stabilized, establishing a solid foundation. If we take the measured height of the wedge and project it upward from the breakout point, the technical math points directly to a target zone between $100 and $120. But technical projections have to survive reality. As of mid-April 2026, silver is trading in the low 80s. It recovered from a dip into the 70s, but it remains heavily subdued compared to those January highs. The technical setup for triple digits is there, but the rally can only materialize if the underlying environment allows it. To find out if it does, we have to look at the physical metal coming out of the ground. The non-negotiable reality of the silver market is a severe supply deficit. The world is consuming more silver than it mines, and 2026 marks the 6th consecutive year of that shortfall. This descending bar chart tracks global silver inventories. To fill the gap between production and consumption since 2021, a massive 762 million troy ounces have been drained from global stockpiles. That deficit is accelerating. In 2025, the shortfall was 40.3 million ounces. For 2026, the gap is projected to widen to 46.3 million ounces, happening at the exact same time total global supply is falling. Miners cannot simply extract more silver to capture higher prices. The vast majority of silver is mined as a byproduct of extracting other industrial metals, like copper, lead, and zinc. That makes supply highly inelastic. It responds very slowly to demand. There are new mining projects slated to come online by 2027 or later. But with existing major operations aging and yielding declining ore grades, those additions offer no quick fix to the current squeeze. A persistent structural deficit creates a hard floor for prices. Any new surge in demand must immediately compete for a strictly limited and shrinking pool of physical metal. Industrial applications are the primary consumers of silver. For years, the rapid global expansion of solar panel installations has been the dominant force driving that consumption. But high prices have forced solar manufacturers to adapt. Through a process called thrifting, they are reducing the amount of silver required for each individual solar cell. Because of this efficiency, silver demand from the photovoltaic sector is actually forecast to drop by up to 19% in 2026. As solar intensity cools, new technologies are stepping in. The massive global build-out of artificial intelligence data centers requires heavy amounts of silver for high-performance servers and electrical components. Simultaneously, the electric vehicle transition provides a growing baseline. A high-end EV can require up to twice the amount of silver as a traditional internal combustion engine. The cross-currents in this market are shifting rapidly. If you're finding this breakdown valuable, take a second to hit the subscribe button and turn on notifications so you don't miss out as these trends collide. Even with the solar sector using less metal per panel, the expanding needs of AI and electric vehicles keep overall industrial demand historically robust. That consumption directly reinforces the tight physical constraints of the market. The supply and demand data points toward a severe squeeze. But we have to address the macroeconomic environment, which stands directly in the way of a runaway rally. A few months ago, markets anticipated multiple interest rate cuts throughout 2026. Lower rates reduce the opportunity cost of holding a non-yielding asset like silver, typically driving aggressive price appreciation. Stubbornly high inflation has destroyed that expectation. At its March 2026 meeting, the Federal Reserve held the federal funds rate steady in the 3.5 to 3.75% range. The central bank needs more evidence that inflation is defeated before easing policy, locking the market into a higher-for-longer reality. Compounding those high rates is a robust U.S. dollar. A strong dollar makes silver more expensive for buyers using other currencies, actively suppressing international demand. This tug-of-war illustrates the massive split in institutional forecasts. J.P. Morgan projects a subdued $81 average. Bank of America targets a speculative $135 to $309. This represents silver's dual identity, an industrial metal starved for supply, simultaneously capped by restrictive financial policy. The multi-year physical deficit has mathematically laid the groundwork for an upward breakout, but an unyielding Federal Reserve and a strong dollar threaten to smother that momentum entirely. Let me know in the comments below, do the physical fundamentals eventually overpower the macro headwinds, or will interest rates keep silver locked down?